Hey everybody, welcome to the ANDIKA Bulletin for November the 3rd, 2022. Well, US equity markets were weaker into the FOMC statement after some good labour market news. The FOMC statement was met with a bit of euphoria, with US stocks having a bit of a kick up as traders saw hopes for a pause. But Powell pissed all that against the wind during the presser with the following exchange. We have some way to go, basically adding that the ultimate level of the terminal rate may be higher than previously expected. The question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how to keep monetary policy restrictive. So as you can see, Powell really took the wind out of the market. See, the market was expecting and got a 75-point increase. But then they thought, he might be doing a soft pivot, just taking things easy, going a bit dovish. No, he's staying very, very hawkish. And the real reason was because of the final statement he said. Pausing is not something we're talking about. So simply put, the downshift in the pace of policy tightening is now irrelevant. And on the back of that, US markets, the Dow down 500 points, it's 1.5%. NASDAQ down 366 points, that's 3.3%. Futures for the Aussie market this morning are down 113 points, so finally a bit of reality is going to hit the ASX. US dollar initially fell when the announcement was made, but as soon as Powell came out with his hawkish comments, the US dollar just skyrocketed again. The Aussie dollar right at the moment is at 63.57. So that's where the set is seen. The market's now really expecting that, the terminal rate will be around about 5.1%. So the Fed, for those that don't know, have now got a Fed fund rate of 3.75 to 4%. They have a range, whereas someone like the RBA, they actually say that is the rate, and currently the RBA rate is 2.85%. So what we now also see is a considerable shift difference between where the Fed's at, they're like up here, and we're down here, the RBA. And all that's going to tell me is the US dollar is going to stay stronger for longer, the Aussie dollar is going to get weaker, and then in turn, there has the flow-on effects. So what does this all mean going forward? Well, rate hike expectations for December and for February. They get January off, so no rate rise then. But they all reversed in terms of their probability of what they might be. They're suggesting now that there's at least a 25% chance that in December, so next month, there'll be another 75-point rise, and about a 55% chance of a 50-point rise in February. So the upside's still happening in terms of where rates are. The US 10 years just shy of 4.1%. So it's just now going to make that next leg up a little bit higher. So stocks just got smashed. It was just not a nice night. And to be perfectly honest, what the market is just basically needs to come up and understand is that he doesn't want to let, this is the Fed, they don't want to let inflation run. They don't want to let it run hot. So they're taking the hard yards now. Unlike the RBA, which again only put rates up 0.25%. They've done that twice in a row, and we've got a CPI running at 7.3%. We're not being tough on it at all. We're like, meow. At least the Fed, he's doing it. He's saying, no, we've got a problem with inflation, and to be honest, I'd rather go in a bit hard, because if we overstep the mark, then we've got easier tools to reverse, like we can cut really quickly. But if we stay really slow and behind, and we're always playing catch-up footy, inflation's going to get more and more entrenched, and that's exactly what the RBA's done. And I think that's simply because our RBA governor, after making that really stupid statement that, hey, rates are going to stay near zero until about 2024, has completely decided he doesn't want to be made a laughingstock again. He's going in super, super cautious, and it's not helping anybody. It was just mind-boggling what the RBA did, on Tuesday of this week, just going in at another 0.25%. So essentially, this is the Fed, they would prefer to over-tighten than under-tighten. That's essentially the takeout there. And this is a direct quote from Powell. If we over-tighten, we can support economic activity. That's true. Powell, if we under-tighten, the risk is inflation is entrenched. So there you go. That's what's happening. So in my opinion, the stock pain is still going to continue. At some point, the pivot the market wants will happen, but it's not there yet. And I just think the market just needs to get a grip on things, particularly here in Australia. We've just been running hot on just absolute nonsense. So we're going to get a little bit of a pushback today, of course. Follow through as well. Bitcoin tested around under 20,000. Gold pumped on the remarks and then dumped on his hawkishness. Oil managed to hold on to some gains despite the hawkish tone. And you just got to believe the Fed probably knew they were just leading the market into a trap today. There's this demand out there by the market. Oh, they're going to pivot. We want to rally. But they've just got to let this thing unfold, and that's just how it's going to have to be. And again, just check out this particular chart. Pivot 1, pivot 2, and then the pause. No, it's not going to happen, people. And what we've got to look forward to for next week for the United States, their CPI and the midterms. Anyway, this is now my first version of a video version of the ANDIKA Bulletin. For those that know, I've been doing an email version for the people that I email out to. I've just decided, what the heck, let's now do one on a video. It's not that much harder to do. So if you like this and you want to make sure you get it every day, click the subscribe button. Help us out. Click on the like button. And I'll be back tomorrow with another ANDIKA Bulletin. Until then, happy Thursday.